December punishes urgency and rewards restraint. This is not an opinion. It is a law that repeats every year without mercy. Urgency feels productive. It feels like commitment. It feels like you're doing the work. But in December, urgency is a liability. The market slows down, not evenly, not politely, but unpredictably. Liquidity thins. Follow-through weakens. Moves start and die without warning. An urgent trader sees this as a problem to solve. A disciplined trader sees it as a condition to respect. Urgency makes you anticipate instead of observe. It makes you click before confirmation. It makes you justify entries instead of waiting for them. You tell yourself you can't miss the move. You tell yourself the year is almost over. You tell yourself one good trade can fix everything. That thinking is poison. December does not reward desperation. It feeds on it. Every rushed entry gets punished by chop. Every forced setup turns into a slow bleed. Every emotional decision gets exposed because there is no momentum to hide behind. Restraint, on the other hand, looks boring from the outside. But boring is not weak. Boring is controlled. Restraint is not fear. It is confidence without noise. It is knowing that capital preservation is a position. It is understanding that survival is success when conditions are poor. It is accepting that you are not required to participate just because the market is open. Urgent traders measure success by activity. Restrained traders measure success by damage avoided. In December, the gap between those two mindsets becomes expensive. Urgency shortens your patience. It narrows your vision. It lowers your standards without asking permission. You start trading setups you would ignore in any other month. You start accepting risk you would normally reject. You start hoping instead of executing. The market senses none of this emotionally, but it responds mechanically. Thin markets amplify mistakes. They do not forgive them. Restraint slows you down. It forces you to see what is actually happening instead of what you want to happen. It keeps your rules intact when temptation is strongest. It keeps your size small when clarity is lacking. It keeps you alive when others are bleeding quietly. December rewards traders who can sit through silence without needing to fill it, who can watch candles form without projecting meaning onto every tick, who can walk away from the screen without feeling like they failed. That is strength. Urgency feels strong because it is loud. Restraint feels quiet because it is disciplined. The market does not respond to volume of effort. It responds to precision. December strips away excess. What remains is patience or pain. If you rush, you will pay. If you wait, you survive. And survival is the first requirement of mastery. The market exposes psychological weakness, not technical failure. Most traders blame charts when they should be studying their reactions. They say the setup failed. They say the pattern stopped working. They say the market changed. But the truth is quieter and far more uncomfortable. The market didn't change. Your tolerance did. Technical failure is rare. Psychological failure is constant. The chart does not force you to overtrade. It does not force you to chase. It does not force you to move stops, add size, or enter early. Those decisions come from inside. The market simply presents information. Price moves, volume fluctuates, structure forms and dissolves. What happens next is entirely mental. Weak psychology interprets uncertainty as a threat. It reacts instead of responding. It tries to remove discomfort instead of manage risk. That is why traders break rules only after they feel something. Fear, frustration, impatience, never before. A trader with weak psychology does not lose because the setup was bad. They lose because they needed the trade to work. They needed relief. They needed validation. They needed proof they were still capable. That need leaks into execution. Entries get early, stops get loose, exits get emotional. The chart didn't cause that. Your mind did. The market is neutral. It is not attacking you. It is not testing you personally. It simply reveals how you behave when outcomes are uncertain. Every loss is a mirror, not of intelligence, not of effort, but of emotional control. Traders with strong psychology can take the same loss and remain intact. Their confidence does not fracture. Their rules do not bend. Traders with weak psychology unravel. They revenge trade. They double down. They change systems mid-session. Not because the system failed, because their mind did. The difference between consistency and chaos is not knowledge, it is containment. Containment of impulse, containment of ego, containment of the need to be right. The market does not require perfection, it requires discipline under pressure. That pressure is internal. When you feel the urge to trade without clarity, that is not opportunity, that is exposure. Exposure of impatience, exposure of insecurity, exposure of fear dressed up as confidence. Most traders would improve overnight if they stopped changing strategies and started controlling reactions. The chart does not know your P&L, it does not know your past losses, it does not know your expectations. But your mind brings all of that into every decision. That baggage distorts perception. You see setups that aren't there. You ignore risk that is obvious. You justify mistakes before they even happen. This is not a technical problem, it is psychological fragility. The market will always move. In ways you cannot predict. That is not the challenge. The challenge is whether you can remain stable when it does. When you stop blaming charts, you start fixing behavior. When you stop blaming the market, you start mastering yourself. And that is where real consistency begins. Doing nothing is a valid and powerful trading decision. Most traders don't believe that. They say it, but they don't live it. They equate action with progress. They equate stillness with failure. They sit in front of the screen feeling pressure to participate. That pressure is not coming from the market. It is coming from ego. The market does not demand your involvement. It does not reward attendance. It does not care that you showed up early and stayed late. It only pays when conditions align. Doing nothing requires more strength than pulling the trigger, because it removes distraction. It removes the illusion of control. When you do nothing, you are forced to sit with uncertainty. You are forced to watch opportunity come and go. You are forced to accept that not every movement is meant for you. That acceptance separates professionals from gamblers. The undisciplined trader feels anxious when flat. They feel unproductive. They feel invisible. So they manufacture trades. They convince themselves the setup is close enough. They shrink their criteria. They trade to escape discomfort. That discomfort is the real work. Doing nothing protects capital. It preserves mental clarity. It keeps your decision-making clean. A trade you never take cannot damage you. A bad trade always does. Most losses are not from good trades gone wrong. They are from trades that never deserve to exist. Those trades only happen because the trader could not sit still. Doing nothing is not passive. It is deliberate. It is choosing not to engage when the odds are unclear. It is recognizing that patience has value even when P&L does not change. Flat is not losing. Flat is neutral. Neutral gives you options. Neutral keeps you flexible. Neutral keeps you alive. Traders blow accounts because they feel entitled to action. They think effort must be rewarded. They think time at the screen must produce results. The market does not work that way. It rewards precision, not persistence. Doing nothing sharpens perception. You stop forcing meaning into random movement. You stop reacting to every tick. You begin to see structure instead of noise. That clarity disappears the moment you feel the need to trade. Professionals wait, not because they are scared, because they are selective. They know their edge does not appear every day. They know forcing trades dilutes expectancy. They know boredom is cheaper than regret. The hardest days are not the volatile ones. They are the quiet ones. Days when nothing happens. Days when the best decision is to shut the platform and walk away. Most traders fail those days, not because they lack skill, because they lack restraint. Doing nothing builds discipline quietly. It trains you to respect conditions. It strengthens the muscle you will need when size increases. If you cannot sit out when there is no edge, you will not sit tight when risk is on. Doing nothing is not weakness. It is mastery without noise. Losses come from impulse, not from lack of opportunity. Opportunity is never scarce. Impulse is never patient. Most traders don't lose because the market didn't give them a chance. They lose because they couldn't wait for the right. 1. The chart always offers movement, but movement is not opportunity. Noise is not edge. Impulse blurs that distinction. An impulsive trader sees motion and feels urgency. They feel late before they are even early. They enter not because conditions align, but because they are afraid to be L. Behind, that fear is expensive. Every impulsive trade is born from discomfort, discomfort with waiting, discomfort with uncertainty, discomfort with being flat while the market moves without you. So the trader clicks to escape that feeling. That click is not strategy, it is relief-seeking behavior. The market does not reward relief-seeking. It punishes it with randomness. Losses stack not because opportunity disappeared, but because standards collapsed. You start taking trades you would reject on a calm day. You ignore context. You ignore time of day, structure, volume. You focus on entry alone, as if entry could save a bad idea. Impulse narrows vision. It shortens memory. It erases rules. You forget why you wait. You forget how many times rushing has cost you. You forget that missing a trade costs nothing. Opportunity does not demand urgency. If it is real, it allows time. If it requires chasing, it was never yours. Most profitable moves are obvious in hindsight because they were obvious in structure. They developed, they gave signals, they respected levels. Impulse ignores development. It jumps ahead of confirmation. It assumes outcome. That assumption is where losses begin. The trader who believes opportunity is rare trades scared. They trade as if this is their last chance. They trade as if the market will disappear tomorrow. That mindset forces bad decisions. Opportunity repeats. Patterns reappear. Edges cycle. What doesn't repeat is capital once it's gone. Impulse trades feel small in the moment. One click, one contract, one quick idea. But the damage compounds, not just financially but psychologically. Each impulsive loss weakens trust in self. Each broken rule erodes discipline. Each forced trade trains the mind to act without clarity. Eventually, even good opportunities get mishandled. The market didn't take that from you. Impulse did. A disciplined trader does not fear missing out. They fear trading without edge. They understand that opportunity is abundant, but only for those who can wait. They accept that most moves are not theirs. They accept that watching without acting is part of the job. They accept that patience is not passive. It is protective. Losses shrink when impulse is controlled. Not eliminated, but contained. You will still lose, but you will lose for the right reasons, and that is the difference between damage and growth. The market always offers opportunity. Impulse decides whether you survive long enough to use it. Discipline matters most when conditions are quiet. Anyone can look disciplined when the market is moving fast, when momentum is strong, when follow-through is obvious. Chaos hides mistakes. Quiet conditions do not. When volume thins and price drifts, every decision is exposed. There is no speed to mask hesitation, no volatility to justify poor entries. Silence removes excuses. This is where discipline is tested. Quiet markets tempt you to interfere. They make you feel irrelevant. They make you question your purpose. So you start doing things you wouldn't do when conditions allowed. You trade without conviction. You micromanage positions. You invent reasons to participate. None of that is discipline. Discipline is not about activity. It is about restraint when nothing demands action. When conditions are quiet, your rules are either real or theoretical. There is no external pressure forcing your hand, only internal discomfort pushing you to act. That discomfort reveals everything. A disciplined trader can sit through dull hours without reaching for the mouse. They do not need stimulation to feel competent. They do not confuse boredom with opportunity. An undisciplined trader panics in silence. They check indicators repeatedly. They overanalyze. Minor price changes. They turn noise into narrative. Quiet conditions amplify the voice in your head. That voice questions your edge. It questions your progress. It questions your identity as a trader. If your discipline is fragile, you listen to it. You trade to silence doubt. You trade to feel involved. You trade to feel like you're still in control. That control is an illusion. True discipline shows up when there is nothing to do, when the best decision is to wait, when the hardest action is inaction. This is where discipline separates skill from survival. Most traders fail not on big days, but on empty ones. They leak capital slowly. They chip away at confidence. By the time real opportunity returns, they are damaged. Quiet conditions demand respect for probability. They demand smaller size or no size. They demand awareness of context. Discipline adjusts behavior to environment. It does not force behavior onto the market. A trader without discipline trades the same way every day. A disciplined trader adapts. They recognize that some days are for execution, others are for observation, others are for preservation. Quiet markets are preservation days. Nothing heroic happens here. No big wins, no dramatic comebacks. Just protection. Discipline in silence builds longevity. It trains patience. It strengthens emotional control. When conditions finally change, that discipline carries over. The trader who learned to wait can hold. The trader who learned restraint can scale. The trader who learned to do nothing can do the right thing when it matters. Discipline is not proven in excitement. It is proven in stillness. And stillness is where most traders reveal who they really are. The trader's mind is the real battleground, not the market. Price does not argue with you. It does not provoke you. It does not care what you believe should happen. Your mind, all of that. The market presents information. Your mind interprets it through fear, ego, memory, and expectation. That interpretation is where battles are won or lost. Most traders think they are fighting volatility. They think they are fighting randomness. They think they are fighting other traders. They are not. They are fighting their own reactions. The urge to be right, the need to recover losses, the impatience to be involved. Those forces exist before the trade and remain after it. The market does not create emotional instability. It reveals it. Every decision you make is filtered through internal pressure. Pressure to perform. Pressure to prove. Pressure to justify your time and effort. If that pressure controls you, the market doesn't need to do anything else. Your mind will sabotage execution all on its own. You hesitate on good trades. You rush bad ones. You exit winners early and hold losers too long, not because the market tricked you, because your mind demanded comfort. Comfort is the enemy of consistency. The disciplined trader understands this battle. They do not try to eliminate emotion. They learn to operate despite it. They accept fear without obeying it. They acknowledge doubt without acting on it. They feel impulse and let it pass. That is mental toughness. The mind wants certainty in an uncertain environment. That contradiction creates tension. Weak minds resolve that tension by forcing action. Strong minds tolerate it. They sit with ambiguity. They allow trades to develop. They let outcomes be unknown. The market rewards that tolerance. Every time you break a rule, it is not because the rule was wrong. It is because your mind was undisciplined. Every time you overtrade, it is not because opportunity was abundant. It is because restraint was absent. The battlefield is internal. Charts do not change behavior. Systems do. Not enforce discipline. Only you do. You cannot outthink the market. You cannot intimidate it. You cannot negotiate with it. You can only control yourself. That control is built in moments no one sees, when you choose not to trade, when you accept a small loss without reaction, when you shut down instead of forcing a result. Those moments shape your edge. The market will always be uncertain. That will never change. The only variable is how you respond to it. Master the mind, and the market becomes manageable. Ignore the mind, and the market becomes unbearable. This is not a technical game. It is a psychological one. And the trader who understands that stops fighting price